Thank you. There are two speaking slots I really don't like. One is the speaking slot right after lunch because everyone wants to take a nap, and the other is between you and the bar. And out of the two, though, I'll take the one after lunch as opposed to the between you and the bar. So welcome, everyone. I'm very happy to be here. As I was briefly introduced, my name is Chris Burry. I am the co-CEO of an organization in Silicon Valley that's known as the US MAC, US Market Access Center. We are a unique global accelerator that we help non-US technology companies scale on a global basis, including coming to Silicon Valley both for customers and for capital. They asked me to spend some time today talking about sort of what is it that you need to be able to do to successfully raise money in the Valley. I'm probably going to talk for about 30 minutes. I want to leave enough time for people to ask questions. But I'd rather this be interactive in the sense of if I'm talking about something and you have a question, just stop me. You don't have to wait. I mean, let's get the questions that you have. Let's get what's going on in your head out as we begin this process. A lot of also what I'm going to say is relevant to just raising capital in general, not just about raising capital in the Valley, but in terms of raising capital here in Poland, in Europe, and in other parts of the world, because investors look for sort of the same thing. So before I go on, just a little bit more about myself. I am a serial entrepreneur. I sold my first software when I was in university and have been involved in a bunch of startups since then, some of them successful, some of them have failed, a couple quite spectacularly failed. In addition to US MAC, I'm involved in two other startups in a very hands-on way right now. And personally, I've been through the process of raising capital for my companies. And I'm also an advisory partner at a venture capital firm in Silicon Valley. So I've actually been on sort of both sides of the fence, listening to people asking for money and also being the person who is asking for money. So having said that, why are we here? We're here to talk about raising money, raising capital in Silicon Valley. Silicon Valley is an interesting place, and I'll talk more about this later, but the amount of risk capital that is in the Valley is really just staggering. There are hundreds of venture capital firms that do investing. About 45 to 50% of all of the venture capital in the US is in Silicon Valley, and that probably equates to today somewhere in the neighborhood of about 25% of all of the venture capital anywhere in the world is in Silicon Valley. So the good news is there's lots of money there. There's lots of money that is looking for a good home. The question is, and the question becomes, how is it that you convince the venture capitalists to give you the money? So first, more bad news. Yes? So, not many. Raising capital is a good thing for your company, but probably the 80-20 rule applies in Silicon Valley. The top 20% of the venture funds make 80% of the money. Probably half of the venture funds don't make any money at all, and probably a quarter of them perform so badly that they don't even return anything back to their investors. It's just you put the money into the venture fund as an investor and you walk away with nothing. So hundreds of firms, but the very top tier are the ones who sort of make all of the money, and in many ways it becomes a cycle where the rich get richer because the best firms that are making all of the money attract the best deals, and the firms that are making the money attract the investors to put more money into the fund that's making money, and so forth. So venture investing as an activity reminds me a lot of Las Vegas, right? Where your odds of getting money is pretty low. The odds of the venture fund getting money is pretty low. But when it all works, everyone makes just unbelievable amounts of money. Interesting phenomenon in the Valley right now is that getting angel investing is far easier than getting venture investing. And the distinction that we make between angel and venture, angel investors are putting up their own money. They're reaching into their own bank account and they're writing their own check. Whereas a venture investor, a venture fund, is investing other people's money. There are a lot of angels, there are a lot of what are called super angels in Silicon Valley. How one becomes a super angel, I'm not really clear. Do you get a cape in the mail one day? I don't know. Getting angel funding is actually a lot easier than venture, but it has created a real problem in that you have lots of angel-backed, lots of seed stage companies that then are competing for a smaller pool of venture money. So you have a lot of companies that got a small amount of money feeding down into the same funnel in terms of the amount of venture funds that are available. And venture funding is hard even for a U.S. startup. Just because you're in Silicon Valley doesn't mean that the odds of you being able to raise venture money, being able to raise capital is that good. It helps to be there, but it's not to say, oh, well, just because I'm in the Valley, I'm going to somehow be able to raise money. So, in order to raise money in the Valley, you have to understand the mindset. And what do I mean by that? The very first thing is it's not about the technology. I'm going to say that again. It's not about the technology. We hear people, not only in the Valley, but from all over the world, and particularly from Central and Eastern Europe, that when you start the conversation with them, they want to tell you about their baby. What do I mean by that? You are the proud parent of some technology, of some invention, of something that you've built. And like any new parent, you want to talk about your baby. Look at its beautiful eyes. Look at its beautiful hair. Did you hear the noise that it just made? Look at my baby. Look at my baby. It's not about your baby. Okay? It is about the business model. It is about how are we going to use whatever this thing is that you have created in order to make money, right? Bill Clinton, when he was running for president of the United States the first time, had a saying in his campaign that it's the economy stupid, meaning that the presidential election would be decided based on whether or not the economy was going well or not. For venture funds, it's not the technology, it's the business model stupid. So, as I said, it's about how do we use the business model in order to make money. My very best mentor, a guy by the name of Vic came to me, we were talking one day, and I asked him, I'm the new kid, Vic, what's the best advice that you can give me? And he said, Chris, just remember, they have lots of money and we want it. Right? Your customers have lots of money and we want it. We want it for you because if you have money, if your business is making money, you're going to be successful. And if your customers are giving you money, it means that I, as an investor, am going to be able to make money. If nobody is giving you money, the odds of us making money go to almost zero. Now, at this point, half the time somebody says, but what about Twitter? What about Twitter, right? Yeah, Twitter is 1 in a billion, right? And the guys at Twitter truly have yet to show that they've figured out how they can make money. And in my opinion, this is just my opinion, right, is that part of the reason that Twitter did an IPO last year was Twitter did an IPO because they haven't figured out how to make money and they needed to raise capital because they were burning through millions and millions of dollars a month. And the only way they could go get the capital to keep burning through millions and millions of dollars a month was to go to the public markets that the venture investors were basically at the point of like, I'm not doing it anymore. I'm not writing anymore. I'm not writing any more checks. So we want to make money. We want to make lots of money, right? This is what you're looking for. We want you to create a company that is built on a business model that grows and grows, and as it grows, it bears more fruit, and the fruit that it bears is in the form of cash. Why is this so important? It's so important because the economics of the venture game are really scary. What do I mean? On average, as a venture investor, a venture capitalist is going to be looking to get 20 times their money back. For every million that they invest into your company, they expect in 5 to 7 years that you will give them $20 million back. If you have taken their $1 million investment and you have grown your business so that your business is now $5 million a year, are you going to be able to give them their $20 million? Not so much, right? They want you to grow that to be a $100 million a year business, because then you can give them their $20 million. Why is it 20? Why is it a 20-time return? Because the truth is 90% of all startups fail. 90% of startups will return $0 to their investors. Okay? So if I have a $100 million venture fund and I write $100 million checks, 90 of those checks, I'm never going to see a penny back. So that 90 million just went out the window. So out of the 10 companies that are left, 5 of them are dead. They just refuse to know it, right? We actually call them zombie companies, right? They're dead. They just refuse to die. You can identify a zombie company because a zombie company is one where you're talking with the founder and the founder's like, yeah, you know, we've struggled a little bit and we've done a pivot and I went and I took a job at Google and I'm doing that during the day, but I'm still working on my startup on the nights and weekends, right? If you've had to quit working on your startup full time and you're now working on it part time, I'm sorry, you're dead. Just admit it, own it, and move on, right? So, 90 dead, 5 zombies, which leaves us 5 companies. Out of those 5 companies, 4 of them will probably give back to the investors what it is that the investors put in. So I put $1 million in, I get $1 million back. So, 99 gone, which leaves me with 1. And that one company out of those 100 investments is where I'm going to make all of my money. Right? So, I need some way to be able to get really outsized returns. The very best venture funds actually probably make money on 5 to 7 out of the 100, right? Not just the 1. But this is why you have to be able to tell a story that your business model is going to be profitable and your business model is going to scale to the point where you can give the investor back lots and lots of money. So, if you want to get capital in Silicon Valley, there's a long list of things that you need, right? I just talked about proof that the business model scales and is profitable. This means people actually giving you money, okay? 5 million downloads, which you gave away for free, okay, is not proof that your business model is profitable and scales. It is proof that you can give something away, right? We're not interested in proof that you can give something away. You are almost always going to have a full-time founder in Silicon Valley. Not a salesperson who joined the team late, not somebody that's just a local guy or whatever. We, as an investor, want a founder. And we want to be able to get into the car and drive over to your office and choke you when things are not going well. We want to be able to physically come and get in your face and say, what's going on? And I need to know that the founder that I'm talking to in Silicon Valley has some pull back home, right? If the person who's in Silicon Valley has no authority in the decision making in the executive body of the company, if I go and I yell at him and I choke him, what am I actually doing? Nothing. I'm achieving nothing. So we are also going to expect that you will be a Delaware C corporation. Why is this? A number of reasons, one of which is that we're lazy. We understand how the U.S. legal structure works. We understand U.S. commercial code. We understand the law. And if things are going sideways, things are going squirrely, we want to know what is the law that is going to be used to sort out whatever it is that's going wrong. So if you are a Polish company and I am an investor, I'm going to say, that's great. You need to flip and you need to become a U.S. company with a Polish subsidiary. That's fine. But at the end of the day, I'm going to make the investment in the U.S. entity. I'm not going to make the investment in the Polish entity because I want U.S. law to apply if we're going to have to, unfortunately, litigate something. And we're lazy. We don't want to figure out what the rules are in Poland. We already know what our rules are. And my mentor also one time said to me, Chris, do you know what the golden rule was? And I was thinking about, okay, I learned this when I was a kid, do unto others, whatever. He said, no. The golden rule is that he who has the gold makes the rules. And if you want gold from a venture capitalist in Silicon Valley, you have to play by their rules. If you don't want to become a U.S. corporation, that's fine. Have a nice day. We have plenty of deals. We have plenty of opportunity in terms of investing in people who will play by our rules, that we don't need to go and play by somebody else's rules. We don't have a problem with leaving the development team overseas. It's a really good idea. Why would I ask you to move your whole development team from Poland to Silicon Valley, where now I'm going to have to pay them 4 to 5 times as much money? And after they have been there for 6 years and they have met a bunch of people, all of a sudden Google shows up and dangles a really nice big package with stock options and all of this kind of stuff. And now all of a sudden your development team is gone. We're all too happy to leave the development team back home, okay? Because it makes money, right? It's cheaper to leave them there and they don't get poached, right? So that's all good. The other thing is you need really good what we call corporate hygiene. And what do I mean by this? I mean you need to have things like shareholder agreements, right? You need to actually have documents that say who owns how much of the company. It's stunning how many times it's like, well, yeah, we did the agreement in terms of, I got 5% and he got 10% and it's on a napkin. And it's like, that's nice. We're really happy for you. But you actually need to have legal documents. You have to have a legal paper trail. Who's on your board? Who are your officers? All of those kinds of things. You need good corporate hygiene. Wrong button. So you've done all that. You have good corporate hygiene. You've made the commitment. You're willing to say, okay, we'll move a founder to Silicon Valley, all of those kinds of things. So what is it then that we're doing in our head as an investor? What's the math that's going on? It all starts with the customer problem, okay? You don't see the word technology there, right? We want to know who is your customer, what is the problem that you are solving for your customer, and how many people have this problem? What is the size of your addressable market? 1, not good. 50 million, better. 1 billion, really good, right? Next thing that we want to look at is how bad is this problem? How severe is the pain? Because people give you money. Remember, they have lots of money and we want it, right? They give you money because you are going to make their need, want, or problem go away. And the more severe that problem is, the more willing they are going to be to give you their money, the more willing they are going to be to give you lots of their money, right? If I am sitting in the middle, of a lake with perfectly clear drinking water, and I'm a little bit thirsty, I have a problem, but it's really not that bad because I can just reach over, grab a little, put it in my mouth, and I'm done. If I'm in the middle of the desert and I haven't had any water for 3 weeks, and somebody shows up with a bottle of water and says, how much would you pay me for this bottle of water? right? You're going to pay a lot for that bottle of water. Every investor has in the back of their head something that we call the funding curve. And it basically is charting out where it is in terms of you've got, how big is the problem and how severe is the pain. If you have a market that has a huge number of people, but the level of pain isn't that bad, that's okay, because if you have 1 billion potential customers, you don't need a very big percentage of those customers to be able to build an interesting business. Likewise, you can have a small number of people, but a really severe pain, and you can build an incredible business around that. There's some kind of funding curve, and all investors have something like this going on in their head. And anything that is on this side of the curve, over here, is not fundable. There's not enough people, and the problem isn't that severe. If my market, to take it to the extreme, if my market is, there are 10 people in the world who have this problem, and each of them is willing to give me €1 to make the problem go away, that's nice, but that's not a business that scales, right? The other side is what's fundable, right? And the farther out you are, in a perfect world, we want 1 billion people with a really severe problem, right? The farther you are out here, the more fundable your company is. So what does the funding process look like? To start with, it's a numbers game. You have to go meet with lots and lots and lots of investors, okay? You can't come to Silicon Valley and say, well, I'm going to meet with 2 people. And of course, my thing is so good that out of those 2, I'm actually going to get 2 term sheets. We had a company from a certain country in another part of the world, not Europe, who we were talking with him on the phone. He was about to come on one of our programs, and he said, well, yeah, I really would like 5 investment offers waiting for me when I get off the plane so that I can evaluate them. And I'm like, oh boy, we have a little bit of an education cycle that we need to go through here. The other thing is that you need to start building the relationships with investors early. You actually want to be building the relationship with investors before you need the money. You don't actually want to be asking for the money when you need the money. You want to be helping them learn about you, learn about what you're doing, and build that relationship over time and deliver on the things that you say you're going to deliver. If you're talking with an investor and you say, we're going to have a prototype done in May, have the prototype done in May. If you run into the investor again and it's July and the prototype isn't done, right? The investor's going to be, these guys don't deliver what they say. Why would I believe him when they do this, right? You need to deliver on your promises. You also need to really do what we call perfecting your pitch. You need to make your pitch to the investors really tight, really clean. You have 4 minutes, okay? Not 4 hours, not 4 days. You have 4 minutes in which, typically at the very beginning, to set the hook with an investor that they say, this is interesting enough for me to invest more time in terms of figuring out whether or not there is a real opportunity here. One of the things that you need to do is, there are all these kinds of pitching events that you can go to. You need to listen to the feedback. But the one single biggest mistake we see people from this part of the world make, other than they talk about the technology, not the business, is that they don't talk about their team. As an investor, we are investing in you. We are investing in you and your ability to get things done. We are investing in your ability to create the company, to fix the problems, to sell the customers, right? A great team can fix a so-so product. A great product can't fix a dysfunctional team, right? You hear stories all the time about, in Silicon Valley, people getting funded and they don't even have a product. Why? It's because of their team. It's because of the track record that they did. This goes all the way back to the founding of Intel, that Bob Noyce and Andy Grove and drawing a blank, third guy, Gordon Moore, went to go found Intel, leaving Fairchild Semiconductor. They raised over $1 million in the 1960s in the course of one day because everybody knew who they were, and everybody was like, that's fine, I'm willing to bet on you as individuals. You need to sell yourself, you need to sell your team, not based on, well, this is my PhD and this is the programming contest that I won, but why are you the right people to build this company? Why are you the people that are going to grow this to a size and a scale that you can give me 20 times my money back? So roughly speaking, the process of the raising capital goes from get introduced to a venture capitalist. The odds of you just walking in and getting a meeting are just this side of zero. I know some people that have done it, but I also know that most of the VCs only take meetings from referrals. They are only going to see you if somebody has referred you to them, and that someone is someone they know and they trust. There are 25,000 startups today in Silicon Valley. That's the best guess. 25,000 technology companies less than 2 years old. That's in a population base of 7 million. What's the population of Poland today? Call it 40. Makes math easy, right? So maybe 6 times the size of Silicon Valley. Imagine Poland with 150,000 tech companies less than 2 years old. Okay? And every single one of those companies is beating on the doors of the VCs saying, I want a meeting because I want you to fund me, right? I have a friend at Google, very senior guy at Google, who gets somewhere between 700 and 800 meeting requests a week. He has someone that works for him, and I asked one day, what's her job? And he looks at me and he says, she's the one who says no, right? She literally goes through his email and just says no, right? She sends a nice, kind reply back saying, I'm sorry, he doesn't have time to talk to you, right? So you have to get an introduction. You do a bunch of meetings. Finally, there's a partner meeting where the partners say, yeah, let's go do a deal. The partners say, this feels good. There's some due diligence where it's like, okay, do you actually have a product? Do you have the customers? Do you have all of these? Term sheet, all legal stuff. Final change in the corporate structure is typically, that's the point at which, if you're from Poland, it would be flipped from being a Polish company to the US company as part of this process. And then you have your first board meeting, in which you have a new member of the board from your venture capital firm who is now there to make sure that you're doing all of the things you need to do to make him lots of money. So there are a lot of different funding sources. This slide just gives you sort of an overview, right, of the different stages and where does the money tend to come from, right? You tend to have sort of early stage, seed, angel. You have A round, sort of first real big equity. You have B, C, D rounds. And then finally you start going out to the public markets. So if you look at Uber, right? Uber is one of the real darlings, one of the real success stories in Silicon Valley. They have their own set of challenges and they're getting beat up in the press right now, but it's hard to argue that they have not been successful. Uber was founded in 2009 with $100,000 from each of the two co-founders, right? This is typically what we call the friends, family, and fools round, right? In October of 2010, roughly a year later, they raised about $1.3 million from a syndicate of about 15 angel investors. It wasn't one person who wrote a check, it was 15 people who wrote probably on average about $100,000 check each. I don't know the exact breakdown of what those were, but that's roughly what it was. A while later, they got their A round. They raised about $11 million Again, it was a syndicate. This is one of the things that you will see a lot in Silicon Valley, is you will see a bunch of investors going together to provide the money. It's done for two reasons. One is that it reduces the risk. For me, I'm not the only guy. Other people have some skin in the game. But it's also very good because what it means is that the entrepreneur has access not only to my network, but to the network and resources of a bunch of other firms, right? So it's not just sharing the risk, it's sharing the resources that are available to help you be successful. I would really encourage anybody that's going to raise money to look at always trying to get it syndicated, because you want access to these other people's networks. They went on to get their Series B, $37 million. Interesting thing in that round is that Jeff Bezos, the founder of Amazon, came in as one of the investors. August 2013, they raised $258 million. And June of this year, they raised $1.2 billion. Right? But this is actually, for a super scaling company, this is the kind of progression that you tend to see. You tend to see a small amount of money to get started. You tend to see about $1 million to $2 million that lets you sort of really get some stuff done. Something in the neighborhood of $10 million that lets you start to aggressively scale, and then the numbers go up from there, right? So this is a real world case, and this is a fairly accurate representation of sort of how the amount of money that's raised in Silicon Valley grows when you're being successful. If you're not being successful, that may be the last money, or that may be the last money, right? So as I said earlier, angels are playing a larger and larger role in terms of what is going on in Silicon Valley. And there are about 2,000 what we would consider to be qualified investors. What that is that's a fairly legal term that says you have a certain amount of income and a certain amount of disposable cash outside of your house. Basically, I have money that I can reasonably invest, and if I lose it all, it's not going to kill me. That's basically what makes a qualified investor. The sweet spot is actually creeping up. It's getting closer to 500,000 in terms of an investment. Used to be down more like 100,000, 250,000. And you're seeing a lot of what we call angel groups, which are angel investors who syndicate with each other. Some of the best known are Harvard Angels, Keiretsu Forum, Band of Angels. Again, part of the reason for the syndicating is it spreads the risk, but it also means that there are lots of people that then I can tap into their network. It also means that you can do better due diligence, because if you have 5 or 6 people looking at the deal, between the 5 or 6 of you, you're going to see things that if you were just looking at it yourself, you wouldn't see. So the typical process in terms of angels is angels will typically evaluate 30 to 50 pitches, and then over the course of 3 to 6 months, it'll get down to somewhere in the neighborhood of 2 to 4 deals that are done. So this is part of the reason why when we say your pitch has to be really, really good, you need to be getting from the 30 to 40 to the 2 to 4. There's an interesting exception. There's a group called the Keiretsu Forum. The Keiretsu Forum will get you a decision in 1 month. It's really good. But the way that they do that is they make you pay to be evaluated. They make you pay roughly $6,000. And what that does is the Keiretsu Forum actually has a dedicated professional due diligence team that does all of the due diligence work, which is how they can do that decision-making process faster. If you're not using Keiretsu, and this is not an endorsement of Keiretsu, I'm just pointing out that they have a different business model. So if you look at the VC firms, there's literally hundreds of them. If you add the private firms, the corporate venture funds, typically they're investing $5 million at a time, $5 million or more. It's very hard for funds to make $500,000, $1 million investments. It's just because if you have a $500 million fund, if you're investing $500,000 at a time, it's just too hard, right? It's just too many investments to do. It's too many investments to manage. Typically, equity stakes go from 20 to 80%. You have the board, the venture capitalist, if they have a 20% stake, their expectation is that they have a board seat. Further rounds, you end up getting diluted. There's lots of stuff. Anyone that wants to talk about term sheets and all of the weirdness that happens, that's fine. Happy to have coffee afterwards. But you need to get as many meetings as possible and manage your expectations. I don't know if this presentation is going to be made available to everyone, but these are right now the most active players. If you look, Kleiner Perkins, which is one of the big firms, they did 50 deals last year. There are a couple that did 50, 60. You come on down to, some of the smaller firms. Sequoia, which is still pretty big, did about 26 deals. Again, as big as these firms are, it's not a lot of deals, right? They're really super selective in terms of who it is that they go to market with. There is a great report that is put out by PwC every quarter that's called the Money Tree Report. And the Money Tree Report is aggregated by PwC from most of the major venture funds in the U.S. in terms of where are they investing, how much are they investing, who are they investing with, all of that. Too far. This is the next collection of data is actually from the Money Tree. So I'm going to be given the hook in a little bit. You can see there's been, since the economic crisis, a slow return, more and more deals being done. In terms of sector, we have software, media and entertainment is actually getting a lot of investment. IT services is getting a surprising amount of investment, but you can see it sort of falls off really pretty quickly. By region, as I said, Silicon Valley is by far the biggest region in the United States. This is Silicon Valley, New York, New England, and then sort of everybody else in the U.S. And so that concludes sort of my quick little stroll through raising capital. We have a few minutes to be able to answer questions, and once we get booted out of the room, if anybody wants to go out back and talk, I'm happy to do that. So, any questions from anyone? Would you like to own 20% of a $10 billion company or 80% of a $1 million company? Do you want 1% of a $10 billion company or 100% of a $100,000 company? I'm not trying to be flippant. It's just this is a constant thing with entrepreneurs, is that if somebody is, a bunch of people gave Uber $1.2 billion. They're not going to give Uber $1.2 billion in exchange for 1% of the company. It's just not going to. It's just not going to happen. And yeah, you need to be careful about giving away equity, but you also have to be realistic. They want enough equity that they can get their 20 times their money back. Yes? Could you ask that again? Painkillers every day. Yes. It's really about, it's not about is it high risk, it's about is it high reward, right? That if you're saying high risk, low reward, you're not going to get money. And it's not, that's not an East Coast or a West Coast thing. Specifically, if I were looking at education stuff, I would be West Coast, not East Coast. But that's just an industry focus issue. It's not a risk reward issue. Other questions? Well, thank you all. Oh. Maybe. This one? All of this is available online at the Money Tree. You can just look up moneytree.com. And they actually have an interactive tool where you can slice and dice and look at quarter and look at stage and look at all of this kind of stuff. It's actually, it's a fabulous resource in terms of being able to pull data. The Money Tree report. Yeah.
Is that like a necessity to go through those stages in order to venture capital, or go straight on to capital, or just you got to go full one after another? Or there's no recipe.
People do it in all different ways, but if you look at the middle of the bell curve, the middle of the bell curve goes angel venture. Other questions? You will maybe see some people that would be willing to invest funds in a fund, but again, this comes back to we really like to know what the rules of the game are. Yeah. You're probably better off. I'm sure that there are people who are limited partners in investment funds that are willing to invest their money in European funds, just as there are Europeans who are willing as limited partners to invest in American funds. But I think it would be rare, not impossible, but it would be rare for a U.S. fund to take and put some of its money in a non-U.S. fund. In part, it probably would violate their charter. Yeah.
Based on that question and that answer, it's safe to assume that you got to use the U.S. company actually getting the funds.
You don't have to be registered, but you have to commit as part of the funding activity that happens. There are always exceptions, right? I mean, there are always exceptions, but 95% of the time, the investor is going to say, yes, I want you to be if I'm a U.S. investor, I'm going to say, I want you to be a U.S. entity. I can't speak to if you're a Luxembourg venture fund, would you want to be forced incorporation in Luxembourg? I don't know. I can't speak to that. So where your corporation is registered is a completely separate issue than where you physically are. So for instance, US MAC is registered in Delaware. Our headquarters is in Menlo Park. So you no, you have to. So for instance, we are incorporated in Delaware, and we have to register US MAC with the California agency that does the registration of companies, but it's basically just saying, look, we're a Delaware corporation and we're doing business here. I mean, it's much more a filing issue as opposed to a registration issue. So, yeah. Time it can be done in as little as a week. You can do most of it on the internet, although I would not recommend that you do it. I would recommend that you actually hire a lawyer. It's typically somewhere in the neighborhood of $5,000 to $10,000, but it's because there's a bunch of things that you really need to get done right, particularly as people not from the United States. And there are some very specific tax issues that can come and kill you if you don't do it right. Because, for instance, if my company in Poland, let's say, is worth 10 million zloty, right? And now all of a sudden I flip it and it becomes owned by a US entity. I don't know if this is the case in Poland, but it is the case in some other countries where that's now a taxable event. You just sold your 10 million zloty company, and whatever the profits are, the tax people come and say, I want that. So you actually have to do the flip as a tax swap, as opposed to a stock swap, as opposed to a stock sale. And I'm not a tax attorney, right? But these are the kinds of things why you need an attorney involved, so that you don't end up all of a sudden having a tax bill for, $1 million and you don't actually have the cash with which to pay the tax. That's a bad day at the office. It matters in the sense that hopefully if you've been through a good incubator or accelerator, you have a really well thought out business model and you have a really thought out plan for how we're going to make money. But it's the output of having been through the program that matters, not the fact that you went through the program. There are plenty of companies that go through incubation programs and come out actually no better off than when they went in. I would recommend a really good one.
Okay, sorry to interrupt you, Chris.
Okay.
But, the time is up. And
right.
If someone wants to ask any more questions, I encourage you to ask Chris personally. But then thank you for a very interesting speech, actually.
Thank you all.